Welcome back to the Institutional Trading Desk. I'm going to show you exactly why retail traders relying on moving average crossovers and traditional technical indicators are getting systematically destroyed in 2026's volatility regime. The market structure has fundamentally changed. High-frequency algorithms now constitute 73% of daily volume across major equity indices. And if you're still waiting for your 50-period exponential moving average to cross above the 200, you're reading yesterday's newspaper while institutions are already positioned for tomorrow's move. Before we proceed, understand this is educational content for informational purposes only. Nothing I present constitutes financial advice, and trading derivatives and leveraged instruments carries substantial risk of loss. Consult qualified professionals before making investment decisions. Now, let me explain something critical that separates institutional order flow analysis from retail chart pattern recognition. When you see a candle form on your screen, you're observing the archaeological remains of a battle that already happened. Institutions don't trade the price, they trade the mechanism that creates price. That mechanism is order flow, and understanding it requires us to completely rebuild your mental model of how markets actually function at the microstructure level. Let's establish what I call the physics of price. Every tradable instrument exists within a limit order book, which is essentially a live auction running at microsecond intervals. On one side, you have passive liquidity. These are limit orders sitting on the bid and ask, representing traders willing to buy or sell at specific price levels. They're providing liquidity to the market, waiting patiently for someone to hit their price. On the opposite side, you have aggressive market orders, traders who are willing to cross the spread immediately because they need execution right now, regardless of getting a slightly worse price. This is where directional conviction lives. The price you see flashing on your screen is simply the last match transaction between aggressive flow and passive liquidity. But here's what retail traders miss entirely. The volume and intensity of those aggressive orders versus the depth and replenishment rate of passive liquidity tells you everything about the true supply-demand equilibrium. When a market is trending upward, you're witnessing aggressive buy market orders continuously consuming the passive sell limit orders on the offer side. The ask gets hit, liquidity is removed, the next price level becomes the new ask, and price walks higher. Seems simple enough. However, and this is where institutional edge emerges. What happens when aggressive sell orders suddenly flood the market during an uptrend, but price doesn't collapse the way technical analysis suggests it should? This is the phenomenon we call absorption, and recognizing it in real time is worth millions of dollars to proprietary trading desks. Absorption occurs when large institutional players are willing to provide enormous passive liquidity at specific price levels, effectively building a wall that aggressive flow cannot penetrate. Furthermore, these institutions don't advertise their intentions. They utilize what we call iceberg orders, a sophisticated order type where only a small portion of the total order size is visible in the limit order book at any given moment. Imagine a hedge fund wanting to accumulate 15,000 contracts of ES futures at the 5,240 level. If they displayed that entire order, every algorithm and trader watching would immediately understand a major player is defending that level, and the market dynamic would shift. Instead, they might show only 200 contracts on the bid. When those contracts get filled by aggressive sellers, the order automatically replenishes with another 200 contracts at the same price. To anyone watching, it appears as though there's modest buying interest, but in reality, there's a 15,000 contract fortress being constructed beneath the market. Crucially, this is how institutions stop trends without moving price. During what appears to be a healthy downtrend with lower lows forming on your chart, aggressive sellers are hitting bids with increasing intensity. Retail traders see momentum. They pile into short positions, and technical indicators confirm the move. But underneath the surface, Level 3 data reveals something entirely different. At a specific price level, thousands of contracts are being absorbed without price breaking lower. The sell orders keep coming, yet that level holds firm. The visible limit orders get consumed and instantly replenish. This isn't random. This is institutional accumulation disguised as market neutrality. Moving into the mechanics of identification, you need to monitor what's called bid-ask volume delta in conjunction with price action. Delta represents the difference between volume executed at the ask price versus volume executed at the bid price. Positive delta means more aggressive buying. Negative delta indicates more aggressive selling. Under normal conditions, during a downtrend you'd expect to see persistently negative delta as sellers overpower buyers. The delta profile would match the price trajectory. But here's where delta divergence becomes your primary reversal signal. When price continues making lower lows, yet cumulative delta starts flattening or even ticking positive, you're witnessing absorption in real time. The aggressive selling pressure that should be driving price lower is being methodically consumed by hidden institutional buy orders. The market is selling, but someone with significantly deeper pockets is buying everything being offered. This divergence between price direction and order flow delta is the footprint of smart money positioning against the prevailing trend. To quantify this precisely, institutions monitor what's called the delta to volume ratio at specific price nodes. If a price level trades 5,000 contracts with a delta of minus 3,000, that's 60% selling pressure. Normal market behavior would see price break that level and continue lower. However, if that same level trades 15,000 contracts over the next interval, with a cumulative delta of only minus 500, something has fundamentally shifted. The selling percentage has dropped from 60% to 33%, despite 3 times the volume. That mathematical signature indicates a large absorptive buyer. Let me give you a concrete example from the March 2026 Federal Reserve announcement. The S&P 500 futures were trading at 5,312 when the statement hit at 2 p.m. Eastern. Initial reaction was aggressive selling, market orders hammering the bid with institutional grade size. Price dropped 47 handles in 90 seconds to 5,265, and every retail trader watching saw a clean breakdown below technical support. Their algorithms triggered short entries, stop losses from longs got swept, and the order flow appeared decisively bearish. Cumulative delta in that 90-second window printed negative 42,000 contracts. But here's what separated the professionals from the amateurs. At the 5,262 level, something remarkable occurred. Over the next 4 minutes, an additional 68,000 contracts traded at that tight range between 5,260 and 5,265. Price couldn't break lower, despite relentless selling pressure continuing to hit the market. And here's the critical observation. Cumulative delta during those 4 minutes was only negative 8,000 contracts. Think about that mathematically. The market absorbed 68,000 contracts of trading activity, but only added 8,000 to the negative delta imbalance. That's an absorption ratio of nearly 8 to 1. The footprint chart becomes your primary instrument. Unlike a traditional candlestick that simply shows you open, high, low, and close, a footprint chart displays the volume traded at every single price tick within that period, separated into bid volume and ask volume. You can literally see the battlefield. If a 5-minute bar shows price ranging between 5,280 and 5,286, the footprint reveals exactly how many contracts traded at 5,280, how many at 5,281, continuing through each tick, and whether those contracts were aggressive buys or aggressive sells. When identifying absorption, you're scanning for what I call a volume cluster with delta neutralization. This appears as a horizontal band of extremely high volume at a tight price range, perhaps 3 to 5 ticks, where total volume is substantial, but the net delta is disproportionately small. Visually, you'll see massive numbers in both the bid and ask columns, but when you calculate the difference, it's surprisingly close to 0. That's your smoking gun. Someone is taking both sides with such size that they're creating a gravitational price level. Additionally, monitor the order book refresh rate. Sophisticated trading platforms allow you to see not just the current depth, but how that depth changes tick by tick. When you observe a price level that consistently maintains deep liquidity despite being continuously hit, you're watching an iceberg. The visible portion gets traded, disappears, and instantly reappears. Normal limit orders don't behave this way. They get filled and vanish. Iceberg orders are programmed to replenish automatically, and their presence indicates institutional intent. Now let's discuss the timing component of delta divergence. Not all divergences lead to immediate reversals. Sometimes institutions are building positions over hours or even days, and price may continue drifting against their accumulation before the reversal triggers. This is where you integrate what's called cumulative delta deviation from price structure. You're measuring whether the cumulative delta trend is decoupling from the price trend over multiple timeframes simultaneously. For example, on a 15-minute chart, if you see 3 consecutive bars making lower lows in price, but cumulative delta across those same 3 bars is rising, that's your initial divergent signal. However, professional confirmation requires checking whether this pattern is also emerging on the 60-minute and even the daily timeframe. When delta divergence appears across multiple timeframes concurrently, the probability of a significant reversal increases exponentially. Single timeframe divergences can be noise or temporary repositioning. Multi-timeframe divergence represents institutional conviction. Furthermore, you need to contextualize absorption within the broader market structure. Absorption is most powerful when it occurs at significant technical levels, prior support or resistance zones, volume-weighted average price anchors, or Fibonacci retracements that institutions also monitor. When order flow absorption coincides with a technical level that algorithms are programmed to respect, you get what I call confluence confirmation. The institution isn't just randomly defending a price, they're defending a price that has structural significance, which amplifies the probability that other market participants will recognize and respect that level once the reversal initiates. Let me walk you through the layered analysis framework we use on institutional desks. First layer is the immediate order flow. You're watching tick-by-tick data, monitoring delta on every single transaction, and identifying when aggressive flow stops moving price efficiently. Second layer is the limit order book depth. You're analyzing how many contracts are stacked at each level, watching for asymmetric liquidity that suggests defensive positioning. Third layer is the cumulative delta profile across multiple timeframes. You're tracking whether the volume-weighted directional bias is aligning with or diverging from price action. Fourth layer is contextual market structure. You're identifying whether absorption is occurring at logical technical levels, where institutions would rationally defend positions. When all four layers align simultaneously, you have what we call a high conviction reversal setup. This doesn't happen multiple times per day. In liquid markets like ES futures or NQ, you might see 2 to 4 genuine institutional absorption patterns per week that meet all criteria. The key is patience and selectivity. Retail traders chase every minor divergence and get chopped up by noise. Professional order flow traders wait for the unmistakable signature where someone with $100 million buying power is systematically positioning against the prevailing trend. Crucially, understanding participant behavior enhances your interpretation. Different types of institutions leave different order flow signatures. High-frequency market makers provide liquidity on both sides and create balanced delta even during directional moves. That's not absorption, that's just their business model. Hedge funds building directional positions typically show persistent one-sided aggression until they're filled, then they disappear. But when you see what appears to be a market maker pattern, balanced two-sided flow, except it's massively concentrated at a single price level with unusual size, that's often a proprietary trading desk or large asset manager disguising accumulation as market-making activity. Additionally, time of day dynamics matter significantly. During the New York Open from 9:30 to 11 a.m. Eastern, order flow is often chaotic, with retail participation spiking and genuine institutional flow mixed with noise. Absorption patterns identified during this window have lower reliability. However, during the London-New York overlap from 8 to 9:30 a.m., or during the afternoon session from 2 to 3:30 p.m., when retail participation drops and institutional rebalancing dominates, absorption signatures carry substantially higher predictive value. Moving into risk management integration, even when you correctly identify institutional absorption, execution timing remains critical. Just because a major player is defending 5,262 doesn't mean price can't briefly spike down to 5,255 and trigger your stop loss before reversing. Institutions have deeper pockets and wider pain thresholds than retail accounts. Your position sizing must account for potential stop hunting below the absorption level before the reversal initiates. The professional approach is using what we call scaled entry with confirmation. When you identify absorption at 5,262, you don't deploy full position size immediately. You enter 25% of your intended size as a pilot position, placing your stop loss below the absorption zone with enough room to avoid premature exit. Then, you monitor whether price begins climbing away from the absorption level with improving delta. If cumulative delta starts printing positive and price breaks above the recent swing high, that's your confirmation to scale into the remaining 75% of position size. This method ensures you're participating if the setup works, while limiting exposure if absorption fails and price breaks through. Furthermore, you need to understand absorption failure patterns. Not every instance of large passive liquidity successfully stops a trend. Sometimes, the selling pressure is simply too overwhelming, even for institutional-sized buy orders. The telltale sign of failing absorption is when cumulative delta at the defended level suddenly accelerates negative despite continued volume. If you're watching 5,262 and cumulative delta goes from minus 8,000 to minus 23,000 over just 60 seconds, while volume surges, that institution just got run over. Their absorption attempt failed, and price is likely to fall significantly further as their stop losses trigger. This is why monitoring the delta acceleration rate is as important as the absolute delta value. Stable absorption shows relatively constant negative delta despite high volume. Selling pressure is present, but contained. Failing absorption shows exponentially increasing negative delta with spiking volume. Selling pressure has overwhelmed the buyer's capacity. When you detect this transition, you immediately exit any long positions taken based on the absorption thesis. The market has spoken louder than the institution's wallet. Let me address a common misconception about order flow analysis. Some retail traders believe they can replicate institutional edge simply by subscribing to a footprint charting platform and watching delta. The data access is necessary, but insufficient. Interpretation requires understanding market microstructure, participant behavior, statistical significance of volume clusters, and contextual awareness of macroeconomic catalysts. An absorption pattern appearing randomly at 3 a.m. during Asian session low liquidity is not equivalent to absorption appearing at 2 p.m. during Fed announcement volatility, even if the mathematical delta signature looks identical. Professional order flow analysis also incorporates what's called relative volume significance. Absolute volume numbers are meaningless without context. If ES typically trades 800 contracts per minute at a given price level during afternoon hours, and you suddenly observe 4,000 contracts per minute at that same level, that 5 times normal volume is statistically significant. However, if typical volume is already 3,000 contracts per minute, and you see 4,000, that 33% increase might just be noise. Institutions use Z-score calculations to determine whether observed volume at a price level represents a genuine anomaly worth investigating. Additionally, correlation analysis across related instruments provides confirmation. When you identify absorption in ES futures at 5,262, check whether similar patterns are appearing in SPY options flow, particularly in near-term put options. If institutional players are defending equity index futures, while simultaneously large put option selling appears, indicating willingness to provide downside protection, that cross-asset confirmation strengthens the reversal thesis. Conversely, if futures show absorption, but options flow remains defensively positioned with put buying, the conviction level decreases. Moving into the psychological dimension, understanding why institutions absorb at specific levels reveals the strategic intent. Absorption isn't random, it's calculated positioning based on expected value. A proprietary desk might defend a level because the quantitative models indicate significant positive expected return from that entry point over the next 3 to 7 days.